If your R&D work in Ireland involves using up materials, chemicals, or power during testing and experimentation, there's a good chance those costs can be included in your R&D tax credit claim. But revenue applies a specific test, and there are a few nuances that can catch companies out, particularly around what happens when your R&D produces something you can actually sell. The starting point is revenue's wholly and exclusively test. For materials and power costs to qualify, the expenditure has to be incurred for the R&D activity itself, not just in a supporting role around it. Materials that are consumed or destroyed during R&D qualify, as do chemicals used in trials and the power consumed as part of the R&D process. If your R&D happens on a production line, only the incremental costs attributable to the experimental work will qualify. The baseline running costs of the production line itself don't count. Where it gets more interesting is the saleable product rule. Sometimes you expect that your R&D will produce an output that has commercial value, like a batch of material from a process trial that's good enough to sell. When that happens, you need to deduct the lower of the cost or the value of that saleable material from your claim. So, for example, if a process improvement trial used 1,000 items at €5 each and 900 of those turned out to be saleable, you deduct the €4,500 cost of those 900 items, and only €500 covering the 100 items that weren't saleable would qualify. But there's an important exception to this. If there was genuine uncertainty at the time the R&D was carried out, meaning success wasn't a given, the full material costs can still qualify, even if the work ended up producing something commercially valuable. This matters a lot in sectors like pharma and biotech, where trials often succeed even though the outcome was uncertain going in. So if there's uncertainty about whether your output would be saleable, or whether the experiment will succeed, note that down as you go. Ireland's R&D tax credit currently stands at 30% of qualifying expenditure, rising to 35%, so getting the qualifying cost right is well worth the effort.